The true origin of modern capitalism. What historians get wrong. Look around you. Almost everything you own, everything you eat, everything you use was produced by a system so vast and so complex that no single person can fully understand it. Factories in one country, materials from another, financing from a third, all coordinated by prices, contracts, and the strange, invisible logic of markets. We call this system capitalism, and we live inside it so completely that we rarely notice how strange it is. The story you have probably been told about how it began is a story of the Industrial Revolution. Steam engines, textile mills, coal and iron. The 19th century when smoke rose over Manchester and Birmingham, and the modern economy was born. That story is not wrong, exactly, but it is like saying a tree began the day someone first noticed its leaves. It ignores the roots. Because by the time those factories filled the air with smoke, the deep machinery of capitalism, the banks, the stock markets, the corporations, the national debts, the whole scaffolding of modern finance had already been in place for centuries. The Industrial Revolution did not create modern capitalism. It plugged itself into a system that had been built long before it. And here is what should really stop you. The true origins of the world we live in are not in the smokestacks of the 19th century. They lie in the counting houses of Italian merchants 600 years ago, in the harbors of a small Dutch republic, in the ambitions of kings who could not pay their armies, and in a single reckless bubble that nearly destroyed a nation before its industry had even truly begun. This is the story of how capitalism was actually built, and it began not with machines, but with money. To find its beginning, we have to go back not to England, but to Italy, and to a class of people the medieval world both needed and despised, the merchants. In the late Middle Ages in the great trading cities of northern Italy, something extraordinary was happening. Venice, Genoa, and above all Florence were reviving long-distance trade on a scale not seen since the Roman Empire. Spices, silks, wool, and grain flowed through their ports, and with that trade came a new problem and a new opportunity. Long-distance commerce is dangerous, slow, and expensive. It ties up money for months or years. It requires trust between strangers across huge distances. And it requires ways to move value without physically shipping heavy chests of coin over roads full of bandits. To solve these problems, the merchants of Italy quietly invented the tools of modern finance. Double entry bookkeeping, that miracle of accounting that lets a business track every asset and every debt against itself, was perfected in Italy in this era. The bill of exchange, a piece of paper representing money owed in one city payable in another, freed commerce from having to move gold and silver. Insurance for ships and cargo let merchants share the risks of the sea. And above all, banking as a profession, taking deposits, making loans, transferring funds across borders grew into a formal art. And it was in Florence in the 15th century that this new craft reached its peak in the hands of a single family whose name has never been forgotten, the Medici. The Medici Bank, at its height, had branches in the great cities of Europe, from Rome to Bruges to London. It lent to merchants, to nobles, and above all to the most demanding customer of the age, the church itself. The Medici accumulated wealth on a scale unknown since antiquity, and used it to fund palaces, cathedrals, and the astonishing art of the Renaissance. But look past the marble and gold, and you will see something quietly revolutionary. The Medici did not just lend money. They perfected the art of turning money itself into a machine. In their branches across Europe, clerks recorded every transaction in leather-bound ledgers, written in careful columns of debit and credit. Bills of exchange flew between cities faster than any coin could travel. Deposits in one country could be drawn as cash in another. At rates the bank quietly adjusted to profit from the difference. In effect, the Medici had built a private financial network stretching across a fragmented continent, moving wealth almost invisibly through a web of paper and trust. Popes, princes, and kings all owed them money, and were therefore, in a very real sense, in their power. This was the first stirring of an idea that would define the modern world. That the people who control the flow of money control something more valuable than any single kingdom. Grasp what had just happened. Money, for the first time on this scale, had become a tool. It was no longer just a store of value or a means of exchange. It could be borrowed, lent, moved across borders, multiplied through skillful management. The Italian merchants had built the toolkit of modern finance, everything from a modern accountant's ledger to a global bank's ability to move funds between cities, several centuries before there was a single steam engine or a single factory. The scaffolding was going up long before the building it would eventually support. But finance alone does not make capitalism. And the next great piece of the machine was forged not by merchants, but by kings in the most expensive activity human beings have ever devised: war. By the 16th and 17th centuries, European monarchs were locked in an escalating cycle of warfare. Cannons, gunpowder, mercenary armies, and the new ocean-going warships were breathtakingly expensive. And no king, however grand his crown, had enough personal treasure to pay for the wars he wanted to fight. So the monarchs turned to the only place that had the money: the great banking houses and, increasingly, the wealthy merchant classes of their cities. They borrowed. They borrowed on a scale never seen before. And this simple, desperate act, kings borrowing money to make war, gave birth to the modern financial system. Because when a king borrows, he does something profound. He turns his own future tax revenues into a tradable financial asset. The lender does not just hand over gold and wait to be repaid. He receives, in effect, a claim on the state itself. And these claims, these government bonds, could then be bought and sold. A promise from a king became a piece of paper that could change hands. This created something extraordinary: the national debt, the idea that the state itself is a permanent borrower, and that its debts are the safest investment in the country. And around these government debts grew the first modern financial markets, whole exchanges where investors bought and sold claims on the future taxes of nations. The Dutch Republic in the 17th century, and then Britain, after founding the Bank of England in 1694, mastered this system. They discovered that a country able to borrow cheaply and reliably could outspend and therefore outfight richer rivals who could not. The state and the market were bound together in a partnership that would define the modern world. And then, in the year 1602, in the harbor city of Amsterdam, all these threads, banking, government finance, tradable paper, and long-distance trade, were pulled together into a single institution that changed the world forever. Its name was the Verenigde Oostindische Compagnie, the Dutch East India Company, known by its Dutch initials as the VOC. It was created to conquer the spice trade with Asia. And to do it, it invented something the world had never seen: the modern corporation. Before the VOC, a trading voyage was usually a one-off affair. A group of wealthy merchants would pool their money to fit out a single ship, share the profits if it returned, and swallow the loss if it did not. When the voyage ended, the partnership ended. The VOC did something radically different. It was designed to last not for one voyage, but forever. And it invited not just a handful of wealthy men, but the whole of Dutch society to invest in it. In August 1602, the VOC held what we would now call the world's first initial public offering. Its founding charter said, in a phrase that echoes down through modern finance, "All the residents of these lands may buy shares in this company." And they did. In that first offering, the VOC raised the astonishing sum of about 6.5 million guilders from more than 1,100 investors. Servants, shopkeepers, widows, sea captains, alongside merchants and nobles, all bought shares in a single, permanent joint venture. And because so many people now owned pieces of this company, a new problem arose. What if a shareholder wanted to sell? A market was needed where these shares could change hands. And so in the same city, in the shadow of a canal-side square, the world's first true stock exchange came into being: the Amsterdam Bourse. Almost everything you know about modern financial markets was born in that Dutch square: shares of stock, bonds, speculation on rising and falling prices, even short selling, the practice of betting that a share will fall, was pioneered there. Futures contracts, options, buying shares with borrowed money, all of it emerged around VOC stock within a few decades of the company's founding. The 17th century Amsterdam market was, in its essential mechanics, already recognizably modern. Traders bought and sold VOC shares day after day, their price rising and falling on news of ships arriving from the East Indies, laden with spices worth fortunes, or of ships lost at sea to storms and pirates. Coffee houses and taverns around the exchange filled with speculators debating rumors from distant ports. Fortunes were made and lost on the strength of a single letter carried by a fast ship. The rhythms of frenzy, hope, panic, and greed that define modern markets were all there 4 centuries ago, in a small Dutch city that had, without quite meaning to, invented the future. The joint stock company and the market where its shares are traded is the atomic unit of the modern economy. Every publicly traded corporation on every stock exchange in the world today, from the giants of technology to the smallest local firm, is a direct descendant of the VOC. The template was set. Ownership of a business could be sliced into thousands of tiny pieces of paper, spread across an entire society, and traded freely, allowing capital to be raised on a scale no medieval merchant could have imagined, and allowing risk to be shared among thousands of strangers. But here is what most tellings of this story leave out. This was not just a financial innovation. It was also, from the very beginning, an instrument of empire. The VOC was granted the power to build forts, raise armies, sign treaties, mint coins, and wage war in the name of the Dutch Republic. It was, in effect, a private corporation with the powers of a state, sent halfway around the world to seize control of trade by whatever means necessary. It conquered islands, subjugated populations, and brutally monopolized the spice trade, sometimes through massacres that would horrify any modern reader. The birth of the corporation was inseparable from the birth of European colonial empire. The joint stock company was not just a way to raise money. It was a machine for projecting national power at a distance, with private capital footing the bill and reaping the profits. That fusion of finance, business, and state power is one of the deepest and most uncomfortable roots of the modern world. And once this new machine existed, it did not take long for it to go spectacularly wrong. Because if ordinary people could buy shares in a company, they could also be tempted into folly. In the early 18th century, another joint stock enterprise took center stage, the South Sea Company of Britain. It was granted an exclusive right to trade with the Spanish colonies in South America. In practice, the trade was small and unprofitable, but investors did not care. They imagined vast riches and they poured money into its shares. In 1720, the price of South Sea Company stock rose to fantastic, dizzying heights, then crashed catastrophically, ruining thousands of investors, including many members of the aristocracy and even the scientist Isaac Newton, who reportedly lost a fortune. The South Sea bubble taught a lesson that every generation since has had to relearn. Markets are not just engines of prosperity. They are also engines of collective madness, capable of inflating and destroying fortunes on a scale unimaginable in any older economy. By the middle of the 18th century, everything needed for modern industrial capitalism was already in place. There were sophisticated banks and government bonds. There were stock exchanges. There were joint stock companies wielding enormous power. There were national debts, insurance markets, and the beginnings of financial regulation. All of this existed before a single spinning jenny or a single steam engine. And this is the point that most histories completely miss. When the Industrial Revolution began, when factories rose in the English Midlands, when steam power transformed transport and production, it did not create modern capitalism. It plugged into a financial system that was already, in its essentials, mature. The great mills and railways were financed by joint stock companies. They were funded through bonds and shares on markets that were already centuries old. They were insured, accounted for, and administered using tools invented by Italian merchants long before. The Industrial Revolution was the moment when this pre-existing financial machinery was finally hitched to a new engine of production. And the result was an explosion of output and wealth unlike anything the world had ever seen. Consider what industry actually needed. A single early cotton mill might cost as much as a nobleman's estate. A single railway line stretching across a country cost more than the entire treasury of a small kingdom. These were sums no individual, however wealthy, could have supplied alone. Only the tools invented in the previous centuries could mobilize such fortunes. Investors bought shares in railway companies just as their ancestors had bought shares in the East India Company. Governments issued bonds to finance canals, harbors, and public works. Banks extended credit to industrialists on the strength of contracts and expected future profits. Without the older machinery of banks, exchanges, and corporations, there would have been no way to mobilize the enormous capital that industry required. You cannot build a railway network across a continent from the savings of one wealthy family. It needs the concentrated capital of a whole nation, gathered through the tools of finance built centuries earlier. The steam engine turned coal into motion, but it was the counting house that turned scattered savings into railways. So step back and look at the true shape of how modern capitalism was actually built. It did not begin with the smoke of factories. It began with the ledgers of Italian merchants inventing the tools of finance. It grew through the debts of kings who could not pay for their wars and had to borrow from their own subjects. It came of age with the birth of the Joint Stock Corporation and the world's first stock exchange in 17th century Amsterdam, an institution designed both to raise capital and to project colonial power. It was tested and tempered by the first great financial bubbles, which revealed both the potential and the dangers of markets. And only then, after all this scaffolding was in place, did the Industrial Revolution arrive to fill the structure with the products of the modern world. And this reveals the pattern that most accounts of capitalism completely miss. The system we live in was not invented by industrialists or engineers. It was invented piece by merchants, bankers, kings, and colonial adventurers over the course of nearly half a millennium. The Industrial Revolution was not the birth of modern capitalism. It was its adolescence. The birth had happened centuries earlier, and the delivery room was not a factory floor, but a merchant's counting house. There is a deeper truth here that echoes down to today. Capitalism was never simply a system of markets, as it is often described. From the very beginning, it was a marriage of markets and states. The state provided the borrower whose debt was safe enough to trade, the charter that made the corporation possible, and the naval power that protected the trade routes. The market provided the capital, the innovation, and the willingness to take risks. Neither side could have built the modern economy alone. The image of capitalism as pure free enterprise standing apart from government is a myth. It never existed. Capitalism, from the day of its birth, was built on a partnership between money and power. So the next time you hear someone say that modern capitalism began with the factories of the 19th century, remember what came before. Remember the Medici in Florence, the government bond traders in Amsterdam, the shareholders of the East India Companies, the ruined investors of the South Sea Bubble. Remember that the world we live in was not built in a generation, but assembled over centuries, one financial instrument, one company, one crisis at a time. Modern capitalism did not begin with the Industrial Revolution. The Industrial Revolution was the arrival of a new tenant in a building that had been under construction for 400 years. And the architects of that building were not the men in the smokestacks. They were the merchants, the bankers, and the empire builders who had been quietly, patiently laying the foundations of the modern world long before anyone thought to give it a name.